I invested $100,000 into JEPI, one of the most popular income ETFs on the planet, right before the market crashed. The market recovered, my money didn't. And the worst part, I collected over $8,000 in monthly income along the way, and I'm still behind. Today, I'm going to walk you through exactly what happened, month by month, so you can see where the money went and why it didn't come back. And stick around, because by the end of this video, I'm going to show you where those monthly dividend checks were actually coming from. It's not where you think. If you've been anywhere near the investing side of YouTube, you've heard of JEPI, the JP Morgan Equity Premium Income ETF. It pays a monthly dividend somewhere around 7.5% to 8% a year. And people love it because that income just shows up in your account every single month like clockwork. The way it works is straightforward. JEPI holds a portfolio of large cap stocks, a lot of the same names you'd find in the S&P 500, but then it sells covered calls against those positions. That's where the income comes from. You're trading some of your future upside potential for premium income today. And when the market is flat or grinding sideways, that trade looks brilliant. You're getting paid to wait. But what happens when the market crashes and then comes roaring back? That's exactly what we're about to find out. I'm setting up two accounts. Both start with $100,000 at the end of February 2025. One goes entirely into JEPI, one goes entirely into SPY. No withdrawals, no rebalancing, just buy and hold through a crash and recovery and see where we end up. Same money, same day, same market, two very different vehicles. Let's go. Within a few weeks of buying in, both positions start sliding. By mid-March, SPY has dropped from $594 down to around $559. JEPI drops from $59.41 to around $57.14. Now right here, right at this moment, JEPI actually looks like the smarter play. It's holding up better. The covered call premiums are providing a little cushion on the way down, and the monthly dividends keep depositing into your account. If you own JEPI right now, you're feeling pretty good about your decision. Then April hits, and both accounts take a real beating. On April 7th, SPY hits a low around $481. That's a drop of almost 19% from where we bought it. Our $100,000 in SPY is now worth about $81,000. JEPI bottoms out about the same day at $49.94. That's about a 16% drop. So our JEPI account is sitting around $84,000. And here's the thing, JEPI is still paying you every month through all of this. You get a check in March, another one in April. So even though the NAV is down, those monthly deposits keep hitting your account. At this point, if you're the JEPI investor, you're thinking, I feel less pain and I'm getting paid while I wait for the recovery. This is exactly what this fund was designed to do. The system is working. Hold that thought. Now watch what happens next. Let's walk through this. May, the recovery starts. SPY jumps back to $589. JEPI moves to $56. 1 month into the recovery, and you can already see a gap starting to form. By June, SPY keeps climbing. Now we're at $618. JEPI barely moves. We're at $56.85. It pays 54 cents in dividends this month, one of the biggest payouts of the year. But look at that NAV column. SPY is covering ground and JEPI is crawling. And this same pattern repeats month after month through the summer and the fall. SPY grinds higher, $632, then $645, $666. Meanwhile, JEPI is still stuck in this $56 to $57 range. The dividend checks keep hitting every month, 35 cents a share, 40 cents a share, but the NAV is just stuck. By September, SPY is at $666. Our SPY account has fully recovered and then some. It's now worth over $112,000. What about JEPI? Well, it's still below where we bought it. Our JEPI account is sitting at $97,800 and we're still underwater after 6 months of dividend checks. So what's going on? Why is JEPI frozen while the market recovers? It comes back to the covered calls. When JEPI sells calls against its portfolio, it's collecting premium. That's your monthly dividend, but it's also capping the upside. Every time the market rallies, JEPI's positions either get called away or they hit a ceiling. The fund collects a small premium and misses the big move. On the way down, those premiums provided a small cushion, a couple % of downside protection, but on the way back up, the covered calls are now working against you. Every single month, the market is recovering and JEPI is selling that recovery away for a fraction of what it's worth. It's like having a speed limiter on your car. In a parking lot, no big deal. But when you need to merge onto the highway and get up to speed with traffic, You can't. The limiter won't let you, and that's JEPI during a recovery. Now fast forward to January 2026. SPY hits $697 a share, a new all-time high. Our SPY account is now worth $117,000 on price alone. JEPI, $58 and change. Our account is at about $101,000, barely above break even after a full year, and only because of the dividends. Let me say that again. The S&P 500 is sitting at an all-time high, and our JEPI investment, the one we bought a year ago, is still barely above water. The market came all the way back and then some. JEPI didn't. Now, a lot of people will say, okay, but JEPI is supposed to protect you on the downside. That's the whole point. You're giving up upside for downside protection. That's the trade. Fine, let's quantify that trade. At the bottom, April 7th, SPY was down 18.9%. JEPI was down 15.9%. On $100,000, that's a difference of about $3,000. JEPI saved you $3,000 at the worst possible moment. But by the time the market recovered, the total gap between the two accounts was over $8,000 in SPY's favor. So you paid $8,000 for $3,000 of crash protection. That's like buying a $10,000 insurance policy on a $5,000 car. The math doesn't work. You're overpaying for the coverage and you're paying with gains you'll never get back. And here's the part that almost nobody talks about. JEPI paid us $8,566 in dividends over the past year. And most people see that and think, great, I earned 8% of my money. But look at the NAV. We put in $100,000. Our shares are now worth $97,770. We lost over $2,200 in share value. So where did the dividend money come from? Part of it came from the options premium. That's real income from the covered call strategy. But part of it is simply the fund handing you back your own money and calling it a dividend. That's not a yield, that's a return of capital wearing a dividend costume. Meanwhile, SPY paid you $1,226 in actual dividends, grew your investment by $13,000 on price alone, and never pretended to be something it wasn't. All right, let's put it all on the board. Here's where each account stands. Roughly 1 year after we invested $100,000, SPY is $114,391. JEPI is $106,336. The gap is $8,055. JEPI collected 7 times more in dividends than SPY, and it still lost by $8,000 because the income couldn't keep up with the growth it gave away. And if you're thinking $8,000 isn't that big of a deal, let's scale this up. Because a lot of people eyeing JEPI for retirement aren't investing $100,000. They're investing a lot more. At $100,000 invested, the gap is $8,000. At $500,000, that's $40,000. And at $1 million, the gap is $80,000 in 1 year. $80,000. That's a year's worth of income for a lot of families. That's not a rounding error. That's real money that you traded away for monthly deposits you may not have even needed yet. Look, JEPI isn't a scam. It does exactly what it says on the label. It turns growth into income. And for someone who absolutely needs monthly cash flow right now, there's a conversation worth having. But if you're still accumulating, if you're still building your portfolio and you don't need that monthly income yet, you are paying for a feature you're not using. And as we just saw, the cost of that feature is very real. You fell almost as far as SPY during the crash. The cushion was about $3,000 on a $100,000 investment. But then you gave back all of that and more during the recovery because the covered calls capped your upside the entire way back up. And a portion of those monthly dividends you were so happy to collect, that was just your own principal coming back to you. The total cost of owning JEPI instead of SPY through this crash and recovery, over $8,000 on a $100,000 investment, over $80,000 on $1 million. Now, I know a lot of you are already typing in the comments, but what about someone who's retired and actually needs the income? What if you had to sell SPY shares to live on? Does that change the math? That's a great question, and it deserves its own video, so that's exactly what we're doing next. Same crash, same timeline, but both investors need to pull income to cover living expenses. We'll see which one actually protects your retirement better. Drop a comment right now. Do you think JEPI catches up when you add withdrawals to the equation, or does SPY still win? I want to hear your take before the next video drops. And if this changed how you think about covered call ETFs, hit the like button. It genuinely helps more people find this video, and I think a lot of folks need to see these numbers before they park their retirement in something they don't fully understand. Subscribe if you haven't already, because the retirement income version of this test is coming soon, and trust me, you don't want to miss those results. Stay disciplined, stay patient, and I'll see you on the next flight.